Welcome to Behind the Ticker, the podcast where we go beyond the symbol and into the strategy. I'm Brad Roth, founder and chief investment officer at Thor Funds, and in each episode, I sit down with ETF managers, CIOs, and industry leaders to break down how these funds are actually built, how they behave in real markets, and how advisors use them in real portfolios. Most people just see a ticker symbol, but we know much more goes on behind the ticker. Hey, Sean, welcome to the show.
What's going on, Brad? How you doing?
I'm great, man. So before we get started, why don't you take a little bit of time, give everybody a bit about your background. From what I read, sometimes it's wrong. You started as an analyst, eventually ran an investment team, and then you went out and built Avery and Company. So can you talk me kind of through that entire journey?
Yeah, no, obviously, thanks for having me, and excited to be here. Yeah, I mean, you're kind of spot on there, right? I think that's the summarized version. But in general, look, first and foremost, Avery and Company, that's, where we're at today. We're hitting our 10-year mark. Founded it, the CIO as well. And, early on, I was an analyst at an endowment at my university, played baseball there. So started very early kind of in that investment journey. From there, became an analyst at a hedge fund, small cap equity analyst, and then continued to migrate, upward to an organization here in Miami, Florida, where, it spanned across, different parts of, call it the financial ecosystem, from, private real estate to, wealth management to asset management to an investment bank. And I was really heading up the capital market side, so the asset management side as an analyst, and then became the director of research and kind of, chief investment officer there. Launched a concentrated equity strategy, and kind of that origin of the, concentration, data-driven, continued on thereafter when we founded Avery and Company here in Miami. So, that same origin of, trying to seek and find, unique, assets and then putting them into a portfolio was really from the very beginning.
Yeah. I mean, we're going to talk about the ETF that you guys have recently launched. But before we do that, I always like to ask, what do you like to do for fun? I'm jealous you're in Miami, so I'm assuming it has a lot to do with the outdoors.
Yeah, I mean, Miami, look, I was born and raised here. Definitely a great place to grow up. Got a chance to visit all the big cities across the country, and I love many of them. And, there's so many parts around the country that I really like and could see myself living. But Miami's great, for fun. I'm a big college football fan. I played baseball in college. So, I also love, baseball. I got a little guy that's, 7 years old playing some baseball as well. So that's fun to watch. So full circle there. Miami Hurricanes fan. So, this past year, I got a chance to go with my dad, really to all the big playoff games for college football. So that was also fun. Ending in, the last 30 seconds of the season, I think weren't the highlight, but, it was a national championship, and was excited to, get there, and, the U is back.
Yeah, that's for sure. It'd be cool. I would love to go. Growing up in Pittsburgh, we have Pitt here, but it's not, a big college program. It's on my bucket list to go to one of those, an Alabama game, a Miami game, one of those big environments where it's a lot of fun and it's hard to hear.
Yeah, there's some good football in Pitt. I mean, you got with the Steelers in the and the college, in general, you got some good running backs coming out of there.
So, give me a high level on Avery and Company. You touched on it a little bit, right? You founded the firm back in 2016. You've been running money. You're publishing research. You're building, this nice following on X, and you've got I believe you still have a podcast called The Inside Scoop. So, for nearly a decade, before you've even touched the ETF wrapper, you've building this drumbeat. So what is Avery, and really what are you trying to build there, soup to nuts?
Sure. Yeah. So the podcast is Around the Desk. It was Inside Scoop. We just changed the name. So Avery Around the Desk, and, share a lot of research there, long story short, but Avery as a whole, the way we think about it is, when you step back, is, our mission is, investing forward. That's ultimately what it is. And we wanted to build a platform that we're, research focused, data driven, and high conviction. I would say those are kind of the main high level elements to it. Is we don't want to spray and pray. We truly want to know kind of like what we own and why, and ultimately not rely on kind of third party research, even though, there's a lot of good research out there. and rely on our own kind of, research data and intuition to make our investment decisions. So that was kind of like the baseline, which is, hey, we can do it because we've done this at other firms, and we can launch and build, the same or similar portfolios, that we were doing in the past. So in general, is taking that and pushing that into Avery and controlling obviously that end to end soup to nuts for ourselves. But look, Avery, at its core is investing forward. That's our motto. Again, it's kind of buzzy, but what are we trying to do is, you step back, you say, where's the world going? Where's it headed? And you're trying to find, different areas that directionally the world's going. And that is your margin of safety. That's also your opportunity. Generally speaking, revenue is your best margin of safety for the time being until it's not. So we're stepping back. We're trying to find friction points out there in the world, being cognizant and, aware of our own surroundings. So you think of like, Uber back in the day, and, you were standing on a street corner and, you're dialing a number, trying to figure out exactly how to, get someone to pick you up. That was friction that we were all feeling. Yet, people were not necessarily building, a product for that. And it took, multiple iterations, Black Car, Black Lane, and, some of the other companies that, came before it. Ultimately, we're sitting here today, and Uber and Lyft have filled that friction. And now they're, 70, $80 billion, market caps. And so that's ultimately what we're trying to do, is stepping back, thinking about directionally where the world is going, trying to segment, different categories that we think we have acumen in, and then, trying to find those companies and management teams, and then putting that into strategy. And for us, our early days were separately managed accounts. So, we have our highest conviction equity strategy called Premier Growth. We obviously have, a more, slightly more diversified strategy that manifests in the ETF that we're talking about, foundational ETF. And that is a ETF that is, 20 to 30 companies in it. So a little bit more diversified, but still kind of meets what we consider to be high conviction. And it's, again, these secular winners and transformation stories that, are trying to position themselves to be kind of those structural winners, or companies transitioning to realign to kind of where the world is going. But directionally is, where's the world going? And then working backwards from that and investing with that, that process and mindset.
Yeah, so you just, like I had said earlier, you just launched AVRY, which I do want to talk about at length, back in January. Can you just talk, since it's so fresh, right? How was the process of getting this fund to market? What are some of the things you've had to learn along the way? I always like talking to new issuers because, it gives some perspective from the entrepreneurial side of what it really takes to get one of these things to market. So if you just talk about the process a little bit, and how you went from ideation to, all right, let's get this thing out, to now it's been almost 2 months, and, what are some of the things we've had to learn and do along the way?
Sure. Yeah. I mean, look, I would say a couple different things. You have to have, time. So, you build some time for yourself. You have to have some money to do it. And then also, you have to have, a investor base out there that, either pre-built, had it leading into it, or, have a process, thereafter to then, build assets. That's kind of like, at a very high level, again, on a macro point of view, I think those are three elements that truly matter if you're going to jump into, the ETF or any sort of investment vehicle market that, has some sort of infrastructure cost to it. Look, I'd say, it's been pretty fun, to be quite frank. Is, I think ultimately it's the why. Why are you doing it? Like, why are you moving into some sort of tool or product or, structure? Again, it's a strategy, but the strategy can be bought in different ways, right? So you can create a fund and a vehicle, and you can sit on the Cayman Islands and have kind of this Delaware Cayman, structure. You can go to Europe because maybe you can create, structures for that. You can go to, other international markets. You can create a mutual fund. You can anything, right? Just sit in SMAs, and that's probably your cheapest option. But also your more complex option, I'd say, from a, managing from a trading and operational standpoint. But ultimately is, we grew up in the SMA market ourselves, and we thought the next step, the next logical step was, hey, we have these investors out there, mostly like RIAs and family offices that, wanted to have access to our process, our acumen, our research, our portfolio. And the easiest way to do that was to have something that could serve their need. And the easiest way to serve their need is something where they can point and click, as opposed to, go to their clients, their end clients, have them sign, sub documents with us directly, we become the sub-advisor to an account. And if they have 500 accounts, you have to do that process, roughly 500 times. And so I think from an accessibility standpoint, that was that was really it. That was the process. But, the journey through that was, going out, reaching out to, learning about the structure, right? So there's nuances to it, and we don't have to get like too deep into it, but you have these boards and advisory boards and things that are more structure and legal aspects to it. And you can either try to go down that route yourself, or you can leverage a third party that does this and has done this multiple times over and over again. So we chose that path, which was let's use somebody, industry experts out there that are essentially building these ETFs and assisting us in the process. So we'll be the investment acumen and work alongside them from a compliance standpoint, from an operational standpoint to some degree, but then utilize a lot of their resources as it relates to structuring these things. So that's it. Like, that's the tedious part, and that lasted call it 3 or 4 months. Just back and forth. I would say we were pretty adamant of, trying to get launched right at the start of the year. So anything we got sent and to answer some questions, you file with the SEC. That goes through an extensive process. And the team that we were working with, were really the ones helping to navigate that with us. And then from there, there's other compliance factors that are involved that we had to make sure that we square out. And then it becomes the fun part, right? Which is kind of like, as you're starting to get to launch day, you're talking with some of your external investors and trying to, just getting excited about the idea that you have this publicly listed security out there. You're talking to exchanges. So next month, or not next month, we're already in March. This month we'll be in Chicago at the CBOE and kind of ringing the bell. So it'd be a cool moment for us right at our 10-year anniversary. I'd say that's part of it. And now we can, go out to market. There's a lot of compliance to it. So keep that in mind as you're thinking about this type of structure. It's much more or less compliant friendly, let's say, to some of the other structures from a marketing standpoint. So you don't see us, posting a lot of stuff directly about it unless it's been pre-approved. So anyways, that's kind of like the whole journey here. And, this is the start of our journey in the ETF world. So we're excited for, now, but also honestly, like the next 3 years.
That's great. And so let's get into AVRY, which is the Avery Foundational ETF. You gave us a little bit at a high level, I think, what you're trying to accomplish. But I found it interesting when I was looking at the holdings, right? You didn't choose growth. You didn't choose tech. You didn't choose innovation fund, right? You chose the word foundational. It seems pretty intentional. So what does that word mean when you're actually sitting down and deciding what goes into this portfolio?
Yeah, that was part of the fun aspect of this too. It's just like you have this one shot to come up with a name. You have this one shot to come up with a ticker. And, you're, in some ways you're asking around. In some ways you're just saying, hey, what are we actually trying to build here? And like, what are like the words and what are the words we can use? What's the ticker we can use that really signifies what we're trying to do here? And honestly, what we've been doing, because again, we've been, running something similar just with a different name, right? But this is its own thing. So, it has its own life, its own beginning, but foundational, right? Foundational ETF. And the point there was pretty simple as, again, we're looking for industries and that are foundational to their, to the future. So if you think of investing, in the future, investing where the world is headed, which is our motto internally, foundational industries that are foundation of the future is monumental to this approach. And then from there, it's, who are the companies that are foundational to that, to those industries, to those subsectors. And from there, it's, you're also looking for, management teams that are generally founder-led. If they're not founder-led, there's someone that's been there for, either since close to the beginning, if not the beginning, that, took over as, CEO or something like that. So again, you have these three, tiers of where foundational just kept coming up for us. And that was, essentially the rationale behind foundational. And look, we're looking for, we don't try to pigeonhole ourselves into, growth or value. I think at the end of the day, we're all value investors at our heart. We're seeking value in these companies. And so we wanted to have this forward-looking approach, and that's like the nature of our firm. But at the same time, you have to have some sort of discipline. So we looked in the market and we said, okay, is this the right strategy for an ETF wrapper? Is this the right strategy for the market in general? And when you look into the ETF ecosystem, you see a couple different things that, are continuous over the last, 5 to 10 years. Started with index-based, cool, low-cost index-based ETFs. You're just capturing beta, you're capturing exposure. From there, it started to, become a little bit more thematic. So you were having a little bit more pinpointed areas of opportunity. And you had these thematic ETFs that come out, and they all do great jobs. People, carve out parts of their portfolio for interesting ideas, whether it's, I want solar, or I want, in this stage, defense, and I want, frontier defense, or whatever you can think of and imagine. There's probably a, thematic ETF for it. And we said, what's actually like somewhat lacking, at least in scale, are actively managed, non-thematic, future-focused, that have, unlimited cash constraints, meaning we can go to, 100% cash should we want to. Therefore, we're aligned, call it, with the investor base. And at the same time, something that is, high conviction. So 20 to 30 names, not, 50, 60, 100 names in a portfolio. And so we, when you put all those things into a blender, you come out and we think we have, a unique little, product that's in market that we've been doing, handling for quite some time. And that was the origin story there. Now, from like a actual process, we have this 6Ms approach, which is really the fundamental drivers, right? I talked about like thematic, where's the world going? What are the key, areas that we're looking for, whether it's identity or automation, or, how mobility is shifting. And then from there, it's okay, let's get to the, the investment process. And those 6Ms are important. You have everything from, the management team. You have, are they aligned with us? Have they executed in the past? You have market, is that market growing? If they're in digital advertising, is that expanding or contracting? Within that, the third M is, market share. Are they capturing market and share in that market? And you can hear, right? If you have a market that's growing, you're capturing market share, you're starting to compound growth pretty considerably. From there, it's margin expansion. That's, the fourth M. Is today's margins, are they under earning, let's say, relative to the opportunity? And we'll see that inflect going forward or whatnot. And then multiple expansion, is there room for, further multiple expansion from here? Or again, going back to my comments around thematic, is sometimes you can get pigeonholed into great stories, great ideas, great markets. But at the same time, the valuations may reflect, Cisco in 1999. And it took, just this past year for you to get, break even at that point in time. And then lastly is margin of safety. So like, that's the 6M, which is, you put everything together and you say, in a bad scenario here, what is it? What's the turnout for us as investors? And ultimately, it's those 6Ms that I think help us understand, the business, but also then, allow us to hopefully compound value over time.
Yeah, so it sounds like a very fundamental, top-down, research-based portfolio that ends up being high conviction. I'm curious, because you said something interesting there. What is then the trigger? You have the ability to go 100% into cash. Like, is that some sort of technical trigger? Is that all fundamental as well? Like, can you talk about that ability, because it is unique?
Yeah. Yeah, it's definitely unique. I mean, look, there's been times where we're sitting in 30, 40% cash. 100% cash is, not likely. That would be, we foresaw, the worst thing ever to happen, and we were somehow ahead of it. The reality is that's not likely, but it's more like valuation driven. So, there's been periods of time over the last decade, I think, where, we're a little bit more skeptical about, valuations more broadly. I would say since COVID, you've actually had more dispersion around valuations in the markets. I think pre-COVID, actually, there was everything was much more normalized. There wasn't as many, push and pulls. You didn't have, different cycles happening at the same time. On one side, you have the consumer spending. On the other side, housing's in a recession and prices are stagnant, but volume is, contracting and sitting at, 2008 lows. And so today you have a lot more dispersion, which arguably I would say means there's more value. So you're more likely and more inclined to stay, be invested. You should be able to find more opportunities in that environment. But, having the ability to raise cash, it's definitely not technically driven. It's definitely more valuation and fundamentally driven. And in a case where we're saying, hey, we need to own, 20 to 30 companies to have that enough diversification to truly be a core holding in someone's portfolio. If we can find 12 really good companies at really good prices, yet we're not that comfortable on another 8, that becomes the cash. And we can do that, pretty quickly. So
Interesting. Thanks for explaining that. So back to, the the portfolio construction itself, like you said, there's about 20 or so names in this portfolio. Some earn a much higher weight, right? You're seeing some weights at 12 and 14%, some at 3%. How are you making those weighting decisions? Do you have a process for that, or is it all come down to valuation and that drives that decision?
Yeah, we definitely have a process for that. The main process is really around valuation, right? So upside downside capture. And then also, at the same time, we kind of have this, when we make rebalances, we have a agnostic approach to weight size, and it's much more spread out across an adjusted factor where we're taking valuation, but then also trying to neutralize that so it's spread out more evenly. So you'll have different cohorts in our portfolio. So if we make a rebalance and, you have the top quadrant of companies that we think valuation is more attractive, those will generally be equally weighted across those. And then the next quadrant and the next quadrant. So you'll see, 6, 4, 5, 3 weights across the board. So it's systematic in that way from a valuation to weight perspective. And then ultimately, what you'll see is we'll let our winners run and then snap them back when, from a technical perspective, if things are starting to shift or valuation gets a little excessive, that's when we'll make a decision to, hey, let's do a full rebalance here, or let's do a partial rebalance in this tier. And that's ultimately how we characterize our weightings versus, just cutting it at a, if it's going from 6 to 7, cutting it right back down to 6. So we definitely let our winners run and then do kind of these capital recycles where, clearly if we still think companies in the portfolio at the bottom end where weights continue to shrink, either because they're not moving higher or they're moving lower while everything else is moving higher, and those theses remain intact, we'll go out and do a rebalance if we think a catalyst is upcoming.
So is your rebalance schedule, do you have a structured rebalance schedule like weekly, quarterly, annually, or is it purely active? You can swap opportunities at any time and or adjust weights at any time.
Yeah, we can adjust weights at any time. I would say, one of the bigger, groundings for rebalance tends to be, just after earnings. You start to get a lot of fundamental information. You kind of let that play through. And then at the end of that, you're probably reassessing some stuff. And in that situation, some of those valuation frameworks may adjust higher, lower. You may had a pop in some name, or a, complete decline in some name. So we kind of let that play out and then reassess and then make some changes. So you would see more of it happening post earnings. But, there's times throughout that journey where you'll see, rebalances happening where, when things are volatile out there, like you're kind of seeing in the markets from time to time, those are obviously periods where you're, maybe not earnings not even happening and you're just trying to recycle capital where you may think, a certain area, a certain pocket of your portfolio is getting hit indiscriminately. And therefore, you think it's very prudent to, add to those and or subtract from others.
So you have a bucket of companies that you call established businesses undergoing transformation. So how do you distinguish a business that is genuinely transforming and one that's just kind of telling you a good story?
Yeah, I mean, everyone's good storytellers these days. If you start with that, I think it allows you to at least a little bit, just take whatever people are saying with a grain of salt, do your own homework, and then again go through the process systematically yourself. So again, going back to the idea, right? There's these areas you want to invest in, right? So the various pockets, let's say again, automation, mobility, future of education, future of health. Underneath that are branches. So in automation, there's obviously, the physical side of automation, which could be robotics. There's the other side of automation, which could be around AI. There could be, robotic process automation, which is just workflow automation. There's automation inside hospitals. So like the branches start to sprawl out underneath those, folders that we deem the areas we want to be in. Within that, there's going to be clearly the structural winners, right? And this is kind of how we segment the market. We have these structural winners within these categories. And then we have the companies that were either legacy incumbents. What you're referring to is companies going through transformation. And we think the biggest dislocations happen in those two pockets, meaning in secular growth, if it's truly secular, meaning the shift from on-premise computing to cloud, right? We're still talking about this today. Amazon, Microsoft, all the hyperscalers still say we're still, not fully penetrated by any stretch. And that just shows you how secular some of these things can get. So mobile, cloud, obviously AI feels that way as well. And the secular growth of those tend to last longer. And the companies that are truly participating in those can also see their revenue and or margins and earnings power last longer than some expect. And that's the dislocation there. So on that side, sometimes those are storytelling and it's easier to see what's actually happening. On the other side is the transformation stories, like you mentioned, and you'll have companies that are in a category, they are the leader and incumbent, the ground is shifting. And, we don't own Microsoft, but I use it as a prime example where in the early 90s, it was the secular winner, right? Internet was booming, it was turning on, productivity tools were turning on, PowerPoint, Word, Excel, everybody needed this stuff. And 2004, 2005, 2006, growth slows, everything's coming down, right? And at that point, the valuation of someone like Microsoft was trading at, single digit, earning multiples. And they had to make a transition. They were still well positioned at this moment in time to where the world was going. It was going towards more software as a service. It was going more towards cloud. It was going more towards gaming, which obviously they executed on there. And they made that transition. And so we're looking for these moments in time where you have an incumbent sitting in a category, ground is shifting, they have time, and you obviously had the leadership team and the product capabilities. You have to have some sort of entrenchment in an ecosystem that gives you time to execute and transition your business. You need a leader that is willing to do it. You need the margins and cash and balance sheet to actually sustain it. And that is that transitional moment where, again, using Microsoft as the example, they went from selling DVDs, CDs to, selling Office 365 as a service. And that was a good example. Then they went into gaming, then they bought GitHub, then they bought LinkedIn. So they started to be more and more attached to where everything was going directionally. And, fast forward to today, it's almost the same thing. Are they well positioned or are they not? And you're seeing dislocations in the market. And these are these transitional moments where I think you can actually find good companies at good prices with good balance sheets and leadership teams that can execute.
You mentioned it, a handful of areas there. Just curious on your perspective as we sit here, today, what is an area in which you might be most excited about? Is it automation? Is it AI? Is it, hardware? Is it energy, technology advancements in energy? What is something that you and your team are really excited about right now?
Yeah. I mean, I would say, obviously, like everything, AI is touching everything, right? So it's hard not to say that, but to be more specific about where the opportunity or like what we're excited about, I think is really around identity. And I think identity, the requirement of identity due to AI is paramount. And I have simple use cases. Again, if you're thinking about opportunities, you're thinking about friction, you're thinking about risk and various things that are happening in the world. I imagine, my kid going to school and someone calling the school and it sounds like me, but it may not be you. I think of the hospitals and, the nurse calling the patient or the doctor and the doctor or the patient and it not being the doctor, email spoofing, so many things, visuals, at some point down the line when you're on a Zoom call, you're not going to know necessarily if that person's that person. So I think all of this is reality. We're seeing some of the early versions of this technology today. And, if we went from, identity fraud a long time ago, it's only going to get worse. But it's going to get worse in every spectrum. So we think that's such a large opportunity. And we have a couple investments in our portfolio to go after that. And that's a big thing, right? So I think identity is super important. I think it's going to touch everything. And therefore that end market is going to be very, very powerful.
So, Sean, as you think about AVRY, you're sitting down with, registered investment advisor. He's got his model portfolio suite. Where are you recommending that he is looking to allocate to this? Is it a core holding in large cap? Is it maybe more of a satellite? I don't want to use the word thematic, but a opportunistic holding alongside just pure equity exposure. Like, how do you think about it?
Yeah, I mean, look, we're definitely positioning it as a core holding, and then you can build around it, meaning we can be fairly flexible. We're going to be in leaders, right? We're going to be in, foundational leaders of industry and foundational, companies in that industry. And so if you step back and you say, what do I want my core holding to look and feel like? Look, I want leadership. I want good management teams. I I don't want to own too many equities, but I want to own enough where, I feel diversified enough. I want to have transparency and understanding of what's in that portfolio and why I own these things, which is why we share a lot of our research. We have a weekly, a webcast where we're just talking about, different things. So there's a level of transparency there that I think, somebody that's, seeking an investment product to build an allocation should feel comfortable with. So having that voice of reason always constantly there, being flexible and being able to speak to, these different groups that are out there, large or small, we make sure we're available. And so I think, again, if you take those characteristics of, leadership qualities, we tend to have pristine balance sheets in our companies and still growth oriented, but not growth at all costs. I think that is a perfect, balance. So you're thematic enough, you're big enough. And I often look at some of our companies in our portfolio that are, let's say, $2 billion or $6 billion market caps with no debt, $1 billion of cash, leaders in their category, sometimes in a duopoly. I'm like, look, these are more powerful, more dominant, more entrenched in their ecosystem than the $50, $60 billion, or $100 billion, TurboTax industry or something like that, right? Where, again, so sometimes it's not misconstruing market cap size for dominance. And in some cases, that actually insulates you from, the big ones, which are, Microsoft's not going to go after a $2 billion market, right? Or a $6 billion market. It just doesn't serve them any purpose. And so in some ways, it almost feels counterintuitive to think that, those wouldn't be a core holding in someone's portfolio. So as long as we're doing the right work and checking off all our checklist to ensure these companies are executing well, I think our view is that it's a core holding.
Well, Sean, I appreciate you spending some time with me today. Before I let you go, where can people learn more about Avery and Company and find all the information they need on AVRY?
Good question. So averyfunds.com, AVORY funds.com is where you'll find, direct information on that. Look, we have again, I talked about the videos we make. That's on our YouTube, Avery Co. So just go to YouTube, type in AVRYCO, and you'll find a bunch of our videos and research. I post a lot on, X at _Sean David. I post a lot on LinkedIn. I see a lot of Brad's posts too, and he does great work over there. So look, we're transparent with our research, and we're kind of everywhere in terms of the platform. So you'll be able to find us.
Well, again, thanks for spending some time with me today.
Awesome, Brad. Same here.